how does a sweep account and a HELOC work, and why is it better than a standard checking account?
Okay, sweep account is, let's say you still have a checking account with the bank, but you want to use the HELOC to operate out of, and you want to automate money that's coming in to eventually end up in the home equity line of credit. Some banks don't have a true routing number where you could say, hey, employer, when I get paid, I want you to directly deposit it into the home equity line of credit. So they set up what's called a sweep account. Sweep account means money goes into your checking account, and it's typically at midnight every night. Whatever balance is in your checking account, they will automatically sweep over into the home equity line of credit. So that way money's not sitting in your checking account doing absolutely nothing for you. It's actually deteriorating in value. It now goes into the home equity line of credit, which reduces the balance of the home equity line of credit. And when you reduce the balance, you reduce the interest that's calculated on it as well. Does that answer your question?
Yes.
Okay.
Yes.
But there was a second part to your question.
And why is it advantageous?
Oh, why is it advantageous? Yeah. Well, sweep account is in conjunction with a checking account. But the benefit of a sweep account is that, let's say you got paid every week. Well, that means that every week, if you know that more time of your money in a checking account is working against you and more time in the home equity line of credit is working for you, then you don't want to lose time. So this automates the process that every time something hits that checking account, as far as good, not necessarily as far as expenses, it's automatically getting pushed over into the home equity line of credit in real time. You don't have the opportunity for human error. Because let's say, you get paid. Most people don't forget when they get paid. But let's say, I forgot I got paid on Friday and now it's Monday. Well, you've lost a couple days that you could have reduced the principal balance of that HELOC, which means you would have saved yourself some interest dollars by it being there. So that's the benefit of a sweep account, is it automates it and it takes out the human error of your money sitting in a checking account for far too long, doing nothing for you when it could have been sitting over here working for you.
So give me an example of what that would look like. Let's say someone earns $10,000 of income from their job.
Yep.
That $10,000 gets deposited into their bank over, let's say, 2 paychecks throughout the month.
So 1st and 15th?
Yeah.
Yeah. Well, let's just talk about interest real quick. So let's say you had $10,000 in principal reduction, right? Now you're not gonna, if you make $10,000, you're not gonna have $10,000 for the entire month of principal reduction. Depending on which strategies we talk about, we do have an offset accounting strategy where we show you how to keep attacking the HELOC, but still paying your bills utilizing an offset account. But let's just use $10,000 as a raw number because you're gonna have bills and expenses. You may have $3,500 of expenses, which means you're gonna have $10,000 swing of the balance going down, then it's gonna pop up $3,500 for the expenses, then 10 grand down, et cetera. But let's just use 10,000. So let's say 10,000 at a 5% interest rate, which is use round numbers. That's $500 divided by 365. So that's $1.36 a day that it saves you, right? Doesn't seem like a big deal, but let's take $100,000. Let's say you had a $100,000 HELOC, right? At 5%, that's $5,000 a year, which means that's $13.69 a day. If your balance stays at $100,000. Now, most people utilizing a home equity line of credit, they're not utilizing it this way. They're utilizing it the way they've been marketed to, the way they've been branded to, the way they have been indoctrinated to use it. Home improvements, debt consolidation, they're not utilizing a HELOC as an operating account where their cash flow goes into it. They're maxing that sucker out and it's staying at that balance until they refinance or they get around to dumping investment money into it or whatever. So it's gonna stay at that $100,000 balance mark for an extended period of time, which means you're paying $13.69 a day, right? Let's say that's a 30-day month, that's $410 of interest, okay? But let's just use that 1 month that you now put 10 grand into it, that goes to 90,000, right? So follow the math, still the same interest rate, divided by 365, that's $12.32 a day instead of the $13.69, right? So that's a $1.36 difference per day over a 30-day period. That's $40.83. Now, that's month one. So people may be watching and be like, I don't do all this to save $40 a month. This ain't worth it. One, how much is liquidity worth to you? But two, that's the first month. We haven't even calculated the second round of funding from your cash flow, the third round, the fourth round. Hopefully you get paid every single month, right? Or every 2 weeks. So every time you're hitting this HELOC, you're affecting the daily interest charges. So that $40 may start off at only $41 of savings month one, but by month 36, this could be a couple $100 of interest savings. It compounds. It's a snowball effect, right? This is where I kind of get on the whole Dave Ramsey thing. It's like you talk about debt snowball and how that's practical and mathematical and it works. This is the same thing. We're literally doing debt snowball, but utilizing a different debt tool that he just doesn't happen to own a bank. He just happens to own a mortgage lender. So I get where he's coming from.
Now remind me how the way that HELOCs calculate interest actually saves me money versus the way a mortgage calculates interest. What's the difference?
Yeah. So a mortgage is an amortization schedule. So let's say it's a 30-year term. It's 360 months, right? So it doesn't matter if you're in month 242, you signed the death pledge contract that says on month 242 of your payment, we've already predetermined how much of your payment is going towards interest and how much is going towards principal. And it's closed in. So again, money can only go in, it doesn't come out freely. On a home equity line of credit, it is not an amortization schedule. It is simple interest recasting every single day automatically for free. So let's talk about recasting. Recasting means that just like a credit card, when money goes in and the balance comes down, the next day your interest charges come down. But again, you've maintained liquidity too because it's an open-end line. You can access it anytime you want. So an amortization schedule versus simple interest line of credit are vastly different in how they calculate interest. In a mortgage world, when I talk about recasting, there are some lenders that will allow you to recast your loan to take advantage of that, right? But what they do is they put this wall up that says, one, if you want to recast, you're going to have to pay us hundreds of dollars, maybe even thousands of dollars to recast your loan. Two, we're going to limit how many times you do it. So logically, we should ask the question, okay, if they're trying to limit me from doing this, then whose best interest is it for? Theirs or mine? Just simple questions. Powerful questions lead to powerful answers. And the reason being is recasting doesn't necessarily benefit them. It benefits you. In the HELOC world, every day, the bank is calculating what your interest is based on that day's balance. So if you can affect the balance every day, you're far more advantageous than affecting it once every 6 months or a year or even a month, right? So the goal is to have income attacking it, reducing the principal balance, and every single day they're recalculating what to charge you in interest based on the lower balance. A mortgage, it's already been predetermined. There's very little you can do to change that.
And is it true that on average, people use your program, the amount that they would pay in interest is less per month on average than if they were to have a mortgage versus a HELOC?
Yes, maybe not in month 1 or 2. I mean, it definitely will be, but it's minuscule, kind of like one of the examples that we talked about earlier. But let's look at over the course of a year. Our average client saves $30,000 of interest in year 1. $30,000. Over the course of 5 years, you're talking about $150,000. Now that's the average. You may have somebody that's got lower income, lower debt. They may not save $30,000. They may save 10. Still an extra $10,000. I mean, we were talking to somebody yesterday, and they were talking about a tax refund and how, yeah, this is really cool. We're actually getting a tax refund. I was like, well, what's it going to be? Like $5,000. I was like, have you understood what that really means? A tax refund means that you overpaid your taxes and you gave the government a interest-free loan for 16 months, only for them to give it back to you 16 months later. That's your $5,000. I was like, would you do that for a friend or a business associate? We're just like, hey, oh, you need money? Here's $5,000. 16 months is when you can give it back to me, and you don't need to pay me a nickel. No, you're not going to do that. But that's what we do to the government. So, one, that's mismanagement of money. But two, why shouldn't we just adjust our withholding? So that's an extra $5,000 coming in our pocket and our additional cash flow that further deteriorates the principal balance of the home equity line of credit and accelerates it even further.
You mentioned you save your clients on average $30,000 in the first
Correct.
year. What do you do for your clients? Tell me a little bit, quick overview of your program.
Really, it's reshaping their thought process and teaching them how to be open-minded and to start looking logically at other areas of opportunity to finance debt differently. We just start with basic math, third grade math. Hey, did you know there's an alternative out there that if you purchase a home or if you refinance a home, 99.9% of Americans are doing mortgages. And we as people, we have this herd mentality. Our neighbor's doing this, our brother, our mother, our whoever's doing this, well, that's the only route to go. We didn't know that there's alternatives to doing real estate other than a mortgage. Everybody else is doing a mortgage, so it must be the only or best way to finance real estate. So what we're doing is we're giving them a paradigm shift that one, there is alternatives, two, to explore those alternatives and do the math on it and see where that leads for you financially. And then three, showing them how to execute. If all we were was a company that says the HELOC is the best method, you can go get a HELOC anywhere. It's how to execute appropriately. Because if you don't know what you're doing, this can absolutely be bad for you. So this is where I will give some credit to some of the mortgage lenders that usually leave YouTube comments out there, because I'm taking food off their table, right? If all the people that aren't consuming mortgages is less people that give them a commission check. So, but they are right. In the wrong hands, this can be detrimental. But I would argue that it's less detrimental than a mortgage is. I mean, you give a mortgage. I mean, look at 2008. We were giving mortgages to anybody that fogged up a mirror. I'd say that was pretty detrimental, not just to those people, but to the entire U.S. economy. So, yeah, it could be detrimental, but not nearly as detrimental as a mortgage.
So do you kind of walk people through the whole process, guide them, make sure they're on the right track?
Yeah, 100%, because it is a maze. It's a financial maze, because the banking world is still the wild, wild west when it comes to HELOCs. The 2010, you got the Dodd-Frank bill where it uniformed mortgages, where every mortgage, in order to be a qualified mortgage, it has to be structured a certain way. And so you've now got FHA, government, Fannie Mae, government, Freddie Mac, government, USDA, government, VA, government. HELOCs is not government backed. So the guidelines are entirely different from bank to bank and credit union, and how you execute is going to be entirely different too. Not to mention, we also hold their hand down the process, because we'll find clients that are 6 months, a year down the road, and they're like, holy crap. And they ask powerful questions. I've got access to $100,000 of equity. I'm starting to spot opportunities. Isn't it crazy how that works? Well, when you have capital, you start spotting opportunities, but when you don't have capital, you don't see them. And so they'll ask powerful questions of, is there something I could be doing with this to better utilize it? Like, heck yeah, there is. Imagine what type of maybe passive or semi-passive cash flow asset you could create with this money that if it increases your cash flow, then what do you think happens to your home equity line of credit balance? The more income you have versus the expenses you have, the faster it deteriorates. So some people just want to use it to become debt free. They're absolutely fine. It depends on where you're at in your life cycle. But some people ask really good questions like, now I've got access to capital. I'm seeing opportunities that are low risk, can give me a monthly dividend or a monthly return. Now I can increase my cash flow. Now you start thinking bigger. It's like, okay, well, if I can do that once, how many times over can I do that? And let's say you take 30 grand to create a $500 monthly cash flow. That's definitely going to blow up the YouTube comments, because people are like, I'm just using random numbers. But feel free to post your negative comments, because it helps the algorithm and gets our videos more seen. So I greatly appreciate your work there. But let's just use round numbers. Let's got $30,000, and I could deploy that into something where I can now create a $50,000 or a $500 monthly cash flow asset. Your cash flow goes up. You quickly pay off the $30,000 faster combined with your original income. But now you can repeat that process over and over again. And let's say you make $5,000 a month, right? Well, now you know that if you repeat that 10 times, you've matched what your employer is paying you. You want to talk about a paradigm shift and a mental shift that when you start going into the office, you're like, okay, I make as much over here semi-passively as I do over here putting up with your crap. I now have options and choices. Some people choose, well, I'd rather have both. I get that. More income, better. Some people are like, I just want the lifestyle and I don't want to have to put up with the crap. You're left with the asset too. So that you could sell that asset for cash if you wanted to. So anyways, it's really cool to help people dream again, because we've found so many people that may be 55, didn't plan accordingly. Maybe they're 60. And the only hope they have is that Social Security doesn't become insolvent and they get to live off Social Security. Now we're like, okay, here's a roadmap. Maybe you're not going to get super wealthy, but maybe your retirement age you can actually hit and live off of retirement, because we're going to show you how to create some assets, how to get access to capital and liquidity. Long story short, it just helps people start dreaming again and start having more joy in their life, knowing that they have options, where in their current reality and the rat race they're in is, here's my paycheck, here's my expenses. The only way I know how to finance real estate is with a mortgage, and I can't do any of these things inside of a mortgage that I could inside of a home equity line of credit. So that's one of the coolest things we get to help people do.
And lastly, how can I work with you?
So first and foremost is just go to our website, because again, we have tons of free information. So if you go to our website, you'll see a carousel there of Replace Your Mortgage. You can set up a profile. It's absolutely free. We have beginner and intermediate courses that you can take that are absolutely free. On top of that, it will then redirect you to a webinar, a live webinar that we do, where we kind of go deeper in the weeds on this. And then that's free. And then the call to action after that webinar is set up your free discovery call, because we need to know if this works for you in your personal finances. And I'll be honest with you, for a lot of people, it doesn't. I wouldn't say a lot. Most people, it doesn't. Because most Americans are living paycheck to paycheck. But if that is not you, all of this whole process to get the foundational education is 100% free on top of the consultation, so we can run your analysis to see if your finances are a good fit for this. And then we spit out the math. Here's your current reality. You're going to pay this much in interest over the next 5 to 7 years. Here's what could be your new reality. And it's $30,000 a year on average savings, $150,000 every 5 years in savings. It's just math. And we break it down very simply to show you, here's what it is on top of, that's the interest savings. But again, I go back to how priceless is liquidity and having access to capital when you need it. I would actually pay a premium for that, especially in this market.